Hi, welcome back. I know it may seem like it's a distraction to talk about growth and profits and reinvestment in the midst of a market crisis. But it's precisely in the middle of a market crisis that we need to remind ourselves of what it is that truly matters. So, if nothing else, here's what I'd like to do. I'd like to go back to an age old truth. We've spent a decade or more valuing scaling up and growth a lot more than building business models and profitability. And in the process, I think we've lost sight of an age old truth, which is ultimately for a good business to succeed, it has to generate profits. I know it's stating the obvious, and sometimes you need a crisis to remind you of the obvious, but we're getting that reminder right now. One reason I think, even if you're focused entirely on the crisis, that you should think about profitability is when one of the issues we're all going to face as investors is which companies are going to come out of this crisis in a sense surviving and looking good, and which companies are going to find their survival at risk in this crisis. And one of the parameters I would look at is how profitable these companies are. I recognize that this crisis is going to put a dent on that profitability. But if you have 40% margins, you can afford to leave a lot more on the table than if you start with 4 or 5% margins. So let's look at the three dimensions that go into what drives the numerator of an intrinsic value. The first is your scaling factor, how quickly you can grow, and holding all else constant, you'd like to grow faster than slower. Growth plays the good guy role. High growth is viewed as good, and low growth is viewed as bad, and negative growth is viewed as something you want to avoid at all costs, which I think is mistaken, but growth does play that role. The second is profitability, which is ultimately growth has no value if it doesn't get accompanied by profitability. The variable that I think best captures this is what kind of operating margin you're going to make as a company. Of course, the amount of debt you have can affect your net profit margin, but you have to start with a healthy operating margin. And the third and the final component of cash flows is how much will you need to reinvest to get that growth. Growth is not free. To grow, you have to reinvest, and the more efficiently you can reinvest, the more valuable you'll be as a company. My simplest proxy for reinvestment efficiency is what I call my revenue to invested capital ratio. How much revenues you get for every dollar of invested capital. So in sum, revenue growth allows me to scale up, my margin allows me to determine how profitable I will be, and the sales to capital ratio tells me how much I will need to reinvest to get that growth. So if you think about a generic firm, and if you think about these three sides to the cash flow triangle, you've got revenue growth, you've got profit margins, you've got reinvestment. The first thing to recognize is those assumptions you make about these three variables have to be linked up. In other words, if you want to project high revenue growth, that's up to you. If you feel the market's big enough and you feel optimistic about the company, you should focus on growth. But you also have to think about the reinvestment that goes with that growth and what will happen to your profit margins if you want to go for high growth. Remember, in many markets, to go for more growth, you got to knock down prices. And if you knock down prices, your margins will be lower. So in a sense, it's good to think of the extreme scenarios, a great company and a terrible company, to see where most companies fall. A great company is able to pull off what I call the trifecta. It's able to grow revenues fast with high profit margins and relatively little reinvestment. It's a very efficient investment machine with high revenue growth and high margins. And if you look at the great companies around you, they tend to share these characteristics. Terrible companies, on the other hand, have a different type of trifecta where they get the worst of all combinations. They get low revenue growth, terrible margins, perhaps even negative margins, and they're terrible investors. They need to invest a lot to get small growth rates and small changes in revenues. Most firms fall in the middle and they have to make trade-offs. Most firms, for instance, have to trade off whether they want to go for high revenue growth or high margins. They can't have both. They have to decide whether they want to reinvest a lot to sustain future margins or reinvest less to be able to get higher profits in the near term. Ultimately, investing and running business is about trade-offs, and this triangle illustrates the trade-offs. So what I'd like to do is take each of these three sides and look at what the world looks like, at least at the start of 2020. Again, I'm a realist. I know that many of these numbers reflect the world we were in pre-virus, and that these numbers will have to get revisited. But again, the way to think about these numbers is the more buffer you had in these numbers before the crisis, the more likely it is you will survive. So let's start with growth. If I asked you what the growth rate was in your company, you might think it's a fact, but really it's not, and here's why. Then the growth rate you will give me will be a function of what metric you look at. And here's my very simple picture to illustrate the difference between the metrics. You can give me growth in revenues. In many ways, this is the purest measure of operating growth, because to grow revenues, you either have to sell more or charge higher prices. You can give me growth in gross profits or growth in operating income. This is it's a rougher measure, because in a sense, you can have small growth in revenues translate into higher growth in operating income, especially if you have a lot of fixed costs. You can give me growth in net income where you're benefited, again, in growing periods, in good periods, by the fact that you have debt. The debt expense remains fixed, and as you grow, your net income will grow faster than operating income. And finally, you can give me growth in earnings per share. One of the things that US companies have been doing for the last 10 or 12 years, and this might be getting them into trouble as well, is they've been buying back shares. So a 3% growth in net income can translate into a 5% growth in operating income, which in turn can become an 8% growth in net income, can translate into a 12% growth in earnings per share. You can already see why when somebody gives you the growth rate for a company, you've got to be careful to ask in what metric. It can also vary depending on the time period looked at. If you take a bad starting point in time, 2009, your growth rates are going to be much better than if you take a good starting point, a good year. It can depend on how you compute the average. You can take a simple average by averaging the growth rates across 5 years, or you can take a compounded average. And if you have a small company getting bigger, you have to remember that those growth rates, even if your company is still a good company, cannot be sustained. A company with $1 million market cap can grow at 100%, but a $100 million company is going to have a much more difficult time maintaining that growth rate. So there are lots of variations in growth, and I thought I'd look at what this number looks like across industries. Here I've listed out the lowest growth and the highest growth industries globally, looking at revenue growth, net income growth, and revenue growth and net income growth over the last 5 years. So again, I've ranked these sectors based on revenue growth, because as I said, I think it's the purest measure of growth. And the worst businesses, at least coming into 2020 in terms of growth, were a lot of them were oil companies, which tells you that the shock that they're receiving is a shock already on top of a shock system. So that's going to make it a lot more difficult. If you look at the highest growth companies, you see a lot of technology companies, you see online retail, but essentially you see technology kind of dominating the high growth businesses. Again, doesn't mean that they're immune, but they have more that they can give up. They have more on the table that they can give up if growth slackens. Now, if you look at growth across regions, remember again, regions have one sector or another dominates. If you look at Australia, you look at Canada, they're dominated by natural resource companies. So what you're going to see as a growth in revenues or net income by region is going to reflect what that sector is focused on, what that part of the world is focused on. So you're going to get that regional focus. And here I've reported two numbers. One is I've reported the revenue growth in the last 5 years and net income growth across companies in each region. And you can look at the median growth rates in each region. And I've also reported an expected earnings growth for the next 5 years. Ultimately, remember, you value companies based on future growth, not past growth. And to the extent that this future growth is different from past growth, it might explain why your company is trading at the pricing that it is. One final point that I looked at, given that expected growth rate is a forward-looking growth, is I wanted to test the conventional wisdom that if you look at stocks, higher PE stocks tend to have higher growth rates, and the conventional wisdom at least is right. It doesn't mean that higher PE stocks are justified based on their growth rate. It just means that given their growth rates, they should have higher PE ratios. We still have to debate how much higher. So that's my growth variable. Let's focus on profit margins. As with growth, there are lots of ways in which you can measure profit margins. Again, let's focus on some of the more common variants. I can look at gross profit as a percentage of revenues. In many ways, this is one of the roughest measures of profits because it's after cost of goods sold. In fact, there are some people who even compute what's called a contribution margin. What's a contribution margin? It takes a portion of cost of goods sold that's a variable cost and computes a contribution margin. So it's essentially the cost of the extra unit that you sell. So you've got gross margins and contribution margins, very rough proxies for the profitability of a business. You still have lots of expenses that are not related directly to the production of the goods and services you sell. If you subtract those costs, SG&A costs, R&D costs, you come up with operating profit. Once you get to operating profit, You get to subtract out interest expense, which are a function of how much you borrowed, to get to taxable income. Then you pay taxes, you get net income. Already you can see that growth rates as you go up an income statement or go down an income statement, and margins as you go up and down the income statement can be very different. Your net margin, your operating margin, your gross margin, your contribution margin can give you very different numbers. And in fact, you can predict in which direction. Net margins will be the lowest because they reflect interest expenses and taxes. Operating margins will be higher than net margins. Gross margins will be higher than operating margins, and contribution margins will be highest of all. Now, to add to the distraction, there are other versions of margins floating around. If I add back depreciation and amortization to my operating income, I come up with EBITDA. You can compute an EBITDA margin. Think of it as a very rough operating cash margin. If I add back R&D, saying I shouldn't have subtracted out, it's really a capex, I come up with an even rougher measure of margin. If I net out taxes from my operating income, it can come up with after-tax operating margin. Again, you can see for the same company, there are 7 or 8 different measures of margins. You're saying, who cares? First, if you're comparing margins across companies, make sure you're comparing on the same metric. Second, you will notice that when companies are truly profitable, they generally don't talk about gross margins or contribution margins. The more you see a company tell you how good their gross margins look, the more concerned you should be, because gross margins will look good for most companies, and for healthy companies they should be much, much higher than operating or net margins. Just to give you a sense of how high gross margins can get, the gross margin for a company like Zoom or Microsoft can be 90 to 95% of revenues. That doesn't mean that 25% margin, a gross margin, is bad, but a 25% gross margin is still a starting point. I half jokingly say that when you tell me that your gross margin looks healthy, that it's 25 or 30%, my response is, it's like a diet, somebody on a diet saying that they ate only 1,800 calories yesterday, but that was before they counted the calories in the second course of every meal they had, the desserts at every meal, and all the snacks they had in between. There's many a slip between the gross margin and the net margin, and it's worth thinking about that. So again, with that setup, let's look at margins across industries, again looking at the highest margin and the lowest margin businesses. If you look at the business with the lowest margins, you'll notice that there are a lot of retail in there, and that should again concern you. This was pre-crisis. Retailing generally had margins in the mid single digits, 3%, 4%, 5%. Some of these, like groceries, might be more protected because their revenues are pretty stable even in a crisis. But as you look at some of the other retailers, you can see how little room they have to essentially move, and the crisis is going to tip them over very quickly. If you look at the business with the highest margins, well, there's no surprises there. You have a lot of technology, you have a few technology companies, and you have green and renewable energy, which is kind of a tech business, so it's a small business still. Tobacco is way up there. I mean, it's nice to have a product or service that's addictive. There are a couple of surprises. For instance, I did not expect to see real estate up there, but the way real estate defines operating profits and revenues is a little difficult to even get your hands around, because depending on how the revenues are computed, your margins can look good only because you're counting only a small portion as revenues. So again, this is not to suggest that the business with high margins will keep them, but they have more buffer going into this crisis. If I break it down regionally, again keeping in mind that different regions have different sector concentrations, you can see again the differences in margins. Africa and the Middle East is perhaps, surprisingly to some people, the most profitable part of the world to be in, partly because you have companies that dominate the local markets, often with very little competition. Looking across the rest of the world, you can see that as you go from EBITDA margins to operating to after tax to net margins, you see the numbers slip. But coming into 2020, at least you get a sense of where these margins stood. And those margins are the numbers that are going to essentially provide the buffer against whatever the crisis will throw at them. Finally, on reinvestment. My measure of reinvestment is much broader than what accountants might call reinvestment. Reinvestment is what you're investing in assets to create long-term growth. And to me, that includes working capital, it includes traditional capex, it includes acquisitions. It's a much broader measure. So I start by defining reinvestment broadly as both investment in long-term and short-term assets, intangible and intangible assets. And then I scale the reinvestment to one of two numbers. I can scale the reinvestment to how much you have as revenues, and if I do that, so I get the sales to invested capital, so I can do that in terms of sales to invested capital, or I can look at what's called a marginal sales to invested capital. What's that? It's a change in revenue every year divided by the change in invested capital. I can also scale reinvestment to after-tax operating income. In fact, if I take the reinvestment I have in any year and divide by the after-tax operating income, I get what's called a reinvestment rate. If I scale it to invested capital, I get what's called return on invested capital. Put simply, companies with high returns on capital and high sales to capital ratios are investing more efficiently than companies with low values in both of those. And that becomes my proxy for reinvestment efficiency. Again, following the template I've used so far, I look at the businesses with the lowest investment efficiency, lowest sales to capital ratios, and the businesses with the highest investment efficiency. Again, you see a concentration. If you look at the lowest investment efficiency businesses, you see a lot of real estate in there, a lot of infrastructure businesses. And the highest investment efficiency, not surprisingly, is in service businesses and technology. So if you look at regional differences, again, allowing for the fact that there are big differences across regions, I look at both the sales to invested capital and the return on invested capital. Incidentally, I forgot to draw your attention to it. Most of the businesses with low sales to invested capitals also tend to have low median returns on invested capital. It's not just enough to, if you're an efficient company, to have a high sales invested capital, but you also need a high return on capital. And you can see some of the businesses that I list as high investment efficiency businesses based on sales invested capital fail the test. Food wholesalers, for instance, look efficient on a sales invested capital basis, but given how much capital they've invested, their return on capital looks pretty bad. So you're looking for a combination of both high sales to capital and high return on capital. And again, you can look across sectors, and looking at the return on invested capital, you can see the setup that's coming for the next part of the discussion. Across the world, and this is with 2019 earnings, before the crisis, companies were already looking at mid-single digit returns on capital. Those mid-digit single returns on capital cannot be explained by 2019 being a bad year, because it wasn't for most of these companies. And it'll get much worse before it gets better. So final part of this discussion, what I'd like to do is talk about comparing the returns you're making, because so far I've focused almost entirely on the cash flow part, is to bring in the risk part. And if you remember in previous sessions, I've talked about hurdle rates. Hurdle rates reflect the riskiness of your business and how much debt you choose to use. And I convert hurdle rates into excess returns. I can do this either at the capital level by comparing, at the business level, by comparing return on capital to cost of capital to get an excess return, or I can even do it at the equity level by comparing return on equity to cost of equity. And again, I did this comparison for every publicly traded company at the start of 2020. Again, I'll concede that these numbers are going to shift down from where they are now, but let's say where they were before the crisis hits. And this is a depressing graph. Pre-crisis, if you look at the percentage of companies globally that were earning returns on capital that were higher than the cost of capital, roughly speaking, about 32% were earning at least 2% or more above the cost of capital. 54% were earning 2% or less below the cost of capital. The other 14% I'm going to leave at around the cost of capital. So if you look at companies even before the crisis hit collectively around the globe, you can see that far more companies were losing over, if you believe the return on capital is a good proxy for what a company is making on its projects, were earning less than their cost of capital. Of course, I'll concede that I'm using 2019 earnings, that maybe some of these companies are young, had a bad year. In fact, I have a similar graph based upon 10-year average returns on capital. And the numbers look better. You get about 44% earning less than the cost of capital, 41% earning more. But then even with normalized numbers, you still get a pretty depressing picture, and that's before this crisis hit. One final point, I looked at the excess returns across industries. Again, I broke down the percentage of companies that earn less than the cost of capital, more than the cost of capital, and you can see the sectors with the most positive and the most negative excess returns. So so when you look at these sectors, again, I'm not suggesting that this is where you should invest, but the sectors with the most positive excess returns are the ones which have the most buffer against crises. The ones with the most negative excess returns already are teetering, and all you need is a push for them to go over. So I'd be worried, given the shocks of this year, as to what will happen to those companies. So in conclusion, for a decade we have glorified growth, often for its own sake, and let profitability fall to the wayside. And as always, we have a reminder. We have a reminder that growth has value only if it's accompanied by profitability, and that if you're a good business, you need to build buffers against shocks. And that buffer, one of the big buffers, is profitability. So in this session, we've looked at profitability. There's the other issue, the other factor that drives how much of a buffer you have, which is how much debt you have. That I will reserve for the next session. But thank you for listening in, and I hope you have a good day.